Oh, wait. Let's unpack this. In a market just, well, awash with information, how do you quickly get to the core of what truly matters, especially when it comes to your investment decisions? Today, we're cutting through that noise, bringing you a really sharp analysis of a company making some significant waves in customer experience and, interestingly, financial crime prevention, too. Welcome to the Deep Dive. This is where we take your sources, the stuff you're looking at, and turn them into actionable insights. Today, we've got a comprehensive stack of expert analysis on one specific company that, frankly, a lot of American investors are watching very keenly, NICE Ltd. That's traded on the NASDAQ, ticker NICE. Our mission today, to give you a clear, well-rounded understanding of this company from an investment expert's perspective, so you walk away feeling genuinely well-informed, ready for your next steps.
Yeah, and what's fascinating here is the need for immediate clarity. Because while there's actually a South Korean company also called NICE Ltd., our deep dive today focuses squarely on the Israeli company. That's NICE Ltd, NICE Systems. The one you'll find on the NASDAQ is NICE. For any American investor tuning in, making this distinction right up front is, well, it's absolutely critical. You want to be sure you're researching the right entity.
That's a super crucial point. Okay, so now that we're clear on which NICE we're talking about, what exactly do they do? I know they're a global leader, but where do they really dominate?
Right. So NICE is really at the forefront of two major high-growth sectors. First, customer experience, or CX, as it's often called. And second, financial crime and compliance solutions. They use cutting-edge tech like AI, artificial intelligence, and RPA, that's robotic process automation. They use these to help organizations not just, improve customer service, but also to optimize their own internal operations and, importantly, to really combat fraud quite vigorously. When you break down their core business, it falls into a few key segments. The big one, their flagship, is CX. CX as a cloud platform, and it's honestly a dominant force in what's called the contact center as a service market, or CS. Think of it like the central nervous system for modern customer interactions. It handles everything from intelligent routing of calls, emails, chats, you name it, all the way to workforce management, advanced analytics, automation, even self-service tools. It helps companies manage millions of interactions pretty seamlessly. Then you've got their financial crime and compliance segment, FCC. This part provides really sophisticated AI and analytics-driven tools. Think fraud prevention, anti-money laundering, AML, and regulatory compliance. Their main customers here are big financial institutions, banks, insurance companies, who are under immense pressure, obviously, to stop illicit activities and meet incredibly strict regulations. And finally, there's a smaller but pretty stable contributor, their public safety and security segment. This offers digital intelligence and investigative analytics, mostly for law enforcement agencies.
Okay, that's quite a broad suite of services. But, with so much going on, is there a risk they become a bit of a jack of all trades, master of none, especially going up against more focused players? Or is that breadth actually their key advantage?
That's a really insightful question. And for NICE, it's definitely the latter. Their strength truly lies in the cloud leadership of CXO. That gives them a really formidable position in this rapidly growing CCaaS market, mainly because of its breadth and its maturity. It's been around, it's proven. What is truly compelling, I think, is their deep AI and analytics prowess. They integrate machine learning across all their solutions, not just, tacked onto one. For them, AI isn't just a buzzword. It's deeply embedded. It provides superior insights and automation that, frankly, are hard for competitors to replicate easily. And crucially, from your perspective as an investor, they operate on a very robust recurring revenue model. Something like over 80%, maybe even higher now, of their revenue comes from these sticky cloud subscriptions and maintenance contracts. That provides a highly predictable, very resilient stream of income. Think of it like a financial cushion. It lets them keep investing in R&D even if the economy slows down a bit. Plus, they benefit from a really diverse customer base, different industries, different geographies, and they have a proven history of smart, strategic acquisitions to boost their portfolio and market reach. It all helps build that competitive moat.
Those pillars sound incredibly solid, yeah. But, as investors, the proof is always in the numbers, isn't it? So let's pivot to the financials, the heartbeat of the company. What should we, as American investors, be really watching for, especially, like you said, with Q2 2025 earnings, maybe just around the corner?
Exactly. By late July 2025, you'd be keenly waiting for that Q2 report, which usually drops in early to mid-August. We'd have already digested the Q1 2025 numbers and the full year 2024 results by then. What you're fundamentally looking for is a consistent story of profitable growth. That's the key phrase. NICE has shown really impressive, consistent revenue growth, largely powered by CXZone, as we discussed. So for you, the investor, you want to look for sustained double-digit revenue growth. And pay close attention to the cloud revenue number. It often grows even faster than the total revenue. And importantly, this isn't just growth for growth's sake, it's profitable growth. They're showing they can scale without tanking their margins. That's a crucial differentiator in the CKS space. In fact, that cloud revenue acceleration was a big highlight in recent reports. Generally, they boast pretty healthy and expanding operating profit margins. It shows you they have a scalable software business model. Keep a close eye on that trend. Also, you'll often hear about their non-GAAP or adjusted margins. It's worth looking at those too.
They strip out certain non-cash items, like amortization from acquisitions or stock-based pay, giving maybe a clearer view of the core operational profitability day to day. Looking at the balance sheet, you'll see their assets reflect that M&A history, lots of intangible assets, goodwill, that sort of thing. They tend to manage their debt pretty prudently, so check the debt-to-EBITDA ratio, make sure it stays reasonable. And critically, their operating cash flow is consistently strong, consistently positive. That's a hallmark of a really robust subscription business. Strong free cash flow generation is key. It shows they can fund their own growth, fund R&D, maybe more acquisitions, without needing a ton of external financing.
Okay, so if the cloud segment is the main growth engine driving things forward, how do investors typically figure out the value of a company like NICE-DE? You know, these high-growth software firms can sometimes look really expensive on traditional metrics like PE. What's the approach here?
Well, that's a good bet. Yeah, growth stocks often have high price to earnings, or PE ratios. So while you'd compare NICE's PE to peers like Five9 or Verint, for a company really leaning into its cloud transition like NICE, the enterprise value to revenue, EV revenue multiple, is often more telling, more useful. Why? Because enterprise value accounts for both debt and cash on the balance sheet. So EV revenue gives you maybe a truer sense of the company's market value relative to its fast-growing sales, especially those cloud sales. You'd compare NICE's EV revenue multiple to its peers, considering their respective growth rates and profit margins too. The real insight for you is trying to judge, does the current valuation fully reflect its strong growth path and market leadership? Or is maybe too much future success already baked into the price? That's the key question. Beyond those multiples, you absolutely need to keep monitoring the cloud revenue growth rate. That's probably the single most important metric right now. Alongside that, of course, watch the total revenue growth rate and the non-GAAP EPS growth.
And for profitability, keep tabs on gross margin, operating margin, and that free cash flow margin we mentioned.
Right. And what about dividends? Is this a stock that pays shareholders back regularly, or is it all about reinvesting for growth?
Yeah, good question. NICE Ltd. does not typically pay a regular dividend. It just doesn't. As a classic growth-focused tech company, it consistently plows its profits back into the business. That means funding R&D to stay ahead, expanding sales and marketing globally, and making those strategic acquisitions we talked about. It's all about fueling future growth. So for you, if you're an American investor looking primarily for dividend income, NICE isn't really the play here. Its appeal is almost purely about potential capital appreciation, the stock price going up over time.
Okay, makes sense. Let's zoom out a bit then. A company like NICE doesn't exist in a bubble, right? How do things like company-specific news, broader industry trends, even global economic shifts, how do they affect this stock? What really moves the needle day to day or quarter to quarter?
Absolutely. It's definitely a multi-layered picture. The most immediate direct influence is always their earnings reports and their guidance for future quarters. That's number one. Beyond that, you want to track any news about their CX-owned cloud momentum. Are they winning big new customers? Are they rolling out cool platform enhancements? What are the adoption rates looking like? Pay really close attention to their AI and automation innovations, especially anything related to generative AI, new features, partnerships. That space is moving incredibly fast. Major M&A or big partnerships can also be significant catalysts, maybe opening up new markets or adding key technology. And keep an eye on how trends in cybersecurity and financial fraud are playing out. More fraud generally means more demand for their FCC solutions. Oh, and don't forget things like analyst rating changes or any major leadership shifts. Those can move the stock too. Then, looking at the broader industry, it raises that important question. How's the overall market landscape for NICE? Well, the cloud contact center, CCase market itself, is still accelerating rapidly. That's a huge tailwind for CXO. It's just pulling them along. We're also seeing massive adoption of AI and automation everywhere, right? Especially with generative AI creating totally new possibilities for customer service automation and even fraud detection. That plays right into NICE's strengths. And unfortunately, the persistent rise in financial crime and the tightening regulatory environment. That continues to drive really strong demand for their financial crime and compliance solutions. It's useful to monitor reports from industry analysts, firms like Gartner or Forrester. They publish rankings, market share data, see if NICE is holding its own or gaining ground against rivals. Rivals like Genesis, Five9, but also increasingly the big guys like Salesforce and Microsoft who are definitely pushing into this space.
And if we connect that to the even bigger picture, the global economy, how do those macro trends impact a global player like 9CE? What are the key forces there?
Yeah, global economic shifts definitely matter. Global GDP growth, for instance, it directly influences how much companies are willing to spend on big IT projects. Slower growth usually means companies tighten their belts. Inflation and interest rates are also critical. Higher rates can nudge up their operating costs, sure, but maybe more importantly, for investors. Higher rates make the future earnings of growth stocks, like NICE, seem less attractive today because you're discounting them back at a higher rate. It can put pressure on the valuation. Also consider the global labor market, a really tight market for contact center agents, for example. That actually increases demand for the kind of automation and workforce optimization tools NICE sells. And naturally, as a global company with significant operations in Israel, exchange rate fluctuations can affect their reported results, just moving currency rates around. And geopolitical risks, tensions in the Middle East, U.S.-China relations, things like that can always introduce broader market uncertainty that affects almost everyone.
Okay, and finally, what about just the overall mood of the market? Investor sentiment. How much does that swing a stock like NICE?
Oh, the overarching market mood. It absolutely matters. A lot, actually. NICE stock tends to be highly correlated with the broader tech sector, and particularly cloud software stocks. They often move together, so you really need to watch whether investors are generally in a risk-on mood, embracing growth, or risk-off, fleeing to safety. And are big institutions putting money into growth stocks or pulling it out? High institutional ownership can signal confidence, sure, but it also means the potential for large block trades if sentiment shifts, which can really amplify the stock's moves up or down.
Right. Of course, no investment is risk-free. So pulling all this together, what are the key potential headwinds or competitive threats that NICE might face? What should investors keep an eye on?
Okay, risks. First, intensified competition. It's fierce in both CX and FCC markets, and it's not letting up. Second, fast evolving technological change, especially around AI. They have to constantly innovate just to maintain their edge. Think about new open source AI models. Could they challenge NICE's proprietary tech down the line? Maybe. Third, cybersecurity and data privacy risks. These are huge for NICE, given the sensitive customer and financial data they handle. A major breach could be absolutely devastating financially and reputationally. Plus, increasing global privacy rules like GDPR and others add ongoing compliance costs and complexity. Then there's the risk of macroeconomic downturns hitting that enterprise IT spending we talked about. Companies might delay projects. Also, keep an eye on M&A-related risks. Integrating acquired companies smoothly is crucial to actually getting the benefits they paid for. Sometimes integrations stumble. And lastly, for a global company, there's always that ongoing foreign exchange rate risk. Competitively in that CX-CTS space, the big names are Genesys, Five9, Twilio with their Flex platform, Talkdesk.
And like I mentioned, even CRM giants like Salesforce and Microsoft are increasingly players here. In the financial crime and compliance (FCC) world, you're looking at competitors like Nasdaq, who own Verafin, FIS, FICO, LexisNexis Risk Solutions, and a whole bunch of specialized RegTech startups. So how does NICE stand out? Well, again, it's the comprehensiveness and maturity of CX Zone. It's the deep AI and analytics providing better insights and automation. And it's that true omni-channel integration handling interactions smoothly across all channels. For FCC, their AI-driven predictive analytics, the stuff that spots really complex fraud patterns, that's often a key differentiator that sets them apart.
Got it. So beyond all those external factors, what about NICE's internal engine? What makes the company itself tick? What are its core capabilities?
Right, looking inward. You definitely need to assess their product and technology leadership. How strong is their AI, their analytics? How robust is their cloud platform architecture? Look at their R&D investment as a percentage of revenue, maybe. How quickly are they adapting to new tech like generative AI? Are they leading or following? Crucial, too, are the management and human resources. Does leadership have a clear vision? Can they execute on it? And maybe just as important, can they attract and keep top engineering and sales talent in these really competitive tech markets? Their go-to-market strategy and sales capabilities are vital. How effective is their global sales force? What are their customer retention rates looking like? Look for metrics like net revenue retention or NRR. Are existing customers spending more over time? That's a great sign. And finally, underpinning it all is their financial health and investment capacity. That strong cash flow, that healthy balance sheet that gives them the firepower for sustained growth and the resilience to weather any storms. Now, while fundamentals are absolutely the driver, many investors do use technical analysis as kind of a supplementary tool, just another lens. For a stock like NICE, you might look at key price levels areas where the stock has previously found support or faced resistance. You'd look at moving averages, the 50-day, 100-day, 200-day lines on the chart. Are they trending up? Are there patterns like a golden cross or death cross? Trading volume is important too. Does high volume confirm a price move, suggesting conviction? And maybe momentum indicators like RSI, Relative Strength Index, or MACD, moving average convergence, divergence. They can sometimes signal if a stock is potentially overbought or oversold in the short term. But, and this is crucial, remember, technical analysis usually reacts to the news and the fundamentals. It doesn't predict them. So it should never be used in isolation, especially around earnings reports when fundamentals can change everything overnight.
Okay, wow. That's a lot to process. So boiling it all down, what does this mean for you, the American investor, who might be considering NESE? What's the overall investment thesis here in a nutshell?
Right. The synthesis, look, NICE Ltd, NASDAQ Q, NICE, is in essence a high-quality, growth-oriented technology company. That's the core identity. It operates in really attractive expanding markets, CX and FCC. Its strong position with the cloud-based CXZone platform, combined with that leadership in AI and analytics, really positions it well for continued growth, I think. So the investment thesis really centers on a few key things: cloud-led growth, leveraging AI and automation across everything they do, a resilient recurring revenue business model, and strong, consistent financials. That's the bull case. However, you absolutely have to be mindful of the risks: intense competition, potential integration hiccups from future M&A, those macroeconomic headwinds we discussed, and the constant challenge of finding and keeping top tech talent. And because it is a high-growth tech stock, it often trades at a premium valuation. That makes it more susceptible potentially to broader market downturns or any slight disappointment in its own growth numbers. Valuations can compress quickly. So for you, the listener, NICE is probably best categorized as a growth stock.
It's likely most suitable if you have a somewhat higher risk tolerance, and your main goal is long-term capital appreciation, not immediate income. Its strong underlying fundamentals certainly make it attractive. But you must be comfortable with those potentially higher valuation multiples and the inherent volatility that often comes with growth stocks. Continuous monitoring, especially of cloud revenue growth, margin trends, and their pace of product innovation will be absolutely crucial for assessing if it remains an attractive investment over time.
That's a great summary. And here's a final thought to leave you with. The speed of AI innovation right now is just, well, it's breathtaking, isn't it? As generative AI keeps evolving at this pace, really consider how NICE's ability or inability to seamlessly weave these cutting-edge capabilities into all its solutions, from customer service bots to fraud detection algorithms, will either cement its market leadership or potentially challenge it. What new frontiers will they tackle next with this tech, and how will that ultimately impact their competitive moat? Something to think about. And that wraps up our deep dive into NICE Ltd, NASDAQ, NICE. We really hope this comprehensive analysis has given you the clarity and the insight you were looking for, leaving you feel truly well-informed about this fascinating company.
Yeah, our goal as always is just to connect the dots for you, take all this complex information from different sources and distill it down into something actionable, something you can really use.
If this deep dive was helpful, please do subscribe to the deep dive for more expert insights tailored just for you. Thanks so much for joining us.